when the market's confused. Steve strolls in with a chart and some probable news. Troy fires up Omega like, let's model this mess, while traders at home whisper, please help me stress test. It's the show where the candles dance. Volatility takes its chance. Steve says rules, Troy says math. Together they chart a hilarious path. Grab your lunch, don't be late. They'll tell you why the market's weird again. Oh, great. They're calling out levels, volatility rebels, equity drama, and index devils. One guy's calm, the other's pressing buttons fast. Is this bullish? Is this bearish? Ah, depends on the past. So tune in, laugh, and maybe learn to. These two make the chaos look almost doable for you. Every Tuesday at noon, hit that stream real quick, because markets are wild, and these two are slick.
Afternoon, Dan. Dan. I'm used to talking to Dan all day. Steve, you're not Dan. You're Steve.
Troy, you've got too many live streams. Didn't you just do one with Mark too?
I just did one with Mark.
You're like a professional YouTuber now.
People, you know what I did today? I went to my, there's a little co-op by my office, and I had about 30 minutes, and I went and I got 2 chicken breasts, and I sit in the car and I listened to a military podcast by Jocko Willink just to prepare myself. Jocko's awesome.
Yeah.
So just anytime I'm feeling worn down, I just hear people like that, and it makes me want to run through a brick wall. So
yeah, Jocko or Goggins, one of those two.
Oh, Goggins is like, Goggin legitimately just makes me feel bad about myself. Jocko like will motivate me. Goggins. How's the market treating you today, Steve? This week, this new year?
Not bad. My directional trading has been pretty good. I took 2 this morning. Both are actually in PLTR. The first was a loser, and then my second was a nice winner where I got back my loss plus some. I've got on a 1 DTE Iron Condor, kind of had a big move this morning in SPX, pushed out of its range, and then dropped right back into the center. So that one's doing well. I put on my typical 3-4 put calendar on Monday. Yesterday, ended up closing part of that out for a profit and then held the rest overnight. And my remaining is up about almost 40% on my current contracts. So that one's doing good. So yeah, can't complain. The new year's starting off well. With one of my best strategies last year was my British Iron Condors, and those have started off the worst, which kind of happens. It's kind of trading, right? So
yeah, it happens. That calendar, I love that calendar. It gives me joy every time you open it, just because I have something very similar about that same time, and it kind of it just warms my heart when you see someone smarter than you doing something that you do. It motivates you.
That's kind of scary.
Yeah, I know. I mean, Steve, we're just kind of chopping, like you said. It's not. I look at this as like, do you trust the move? I mean, I know we're not macro guys, but do you trust the move over 6,900? Do you think is 7,000 happen before we go to 6,800 again?
I think so. Yeah, I think new all-time highs is inevitable.
Yeah.
That's my opinion.
Yeah,
which is worth not very much, Troy. I gotta be honest. It's not.
No, it's hard to argue against it. I tell you what's hard to argue against as well, Steve, is I last year took a look in at gold, and for those who don't know, gold basically, I think it doubled last year. I mean, which is a pretty crazy move. I could be wrong about that, but it went up a lot last year. Silver doubled. So anytime you have these kind of commodities doubling, that's spicy. And, those are a lot more liquid than Bitcoin. So when you get stuff like that moving at that level, it's kind of like Bitcoin, what it wishes it could be sometimes, I think. And so, silver yesterday was up 7% at some point intraday market. It's up 4 or 5% today. So, we're going, and I was thinking about it. I would be interested to know, and I was hoping maybe you would be up for us modeling out today. What are some stuff, if you were looking at it gold, like let's do the bear, bullish, neutral case. If I'm bearish gold and I say to myself, this is bull crap, like there's no way this holds. Well, first off, which one of those do you think's? My guess is probably you're the neutral guy that's like, let's just make money from it.
Yeah, I think I mentioned this to you a while back when gold was kind of ramping up earlier or mid-year last year. I think you were on one of our live streams and you asked what I was doing in gold, and I said I'm watching it every day, and it keeps hitting new highs, and I keep waiting for something for me to be able to do, and I just haven't done anything. So I literally missed the entire move.
Yeah.
Did not catch any of it. And so, now, looking at it today, for example, it looks like it's heading back up towards all-time highs. I don't think I would get short gold here. It's just got too much momentum. I don't think I'd get long. I'm not long or short. So, that kind of tells you what I'm actually doing. But, one strategy that, and as you know, I've kind of gravitated the vast majority of my trading to intraday stuff. Don't do a whole lot of overnight at this point. But, one strategy that I used to trade a lot that I think could be a really good option for gold right now would be my hedgehog strategy.
Ooh, can we look at that? Could I model that out?
Yeah. If you want to model it.
I've got gold open, so this works out well.
Yeah. So the way that I would structure this is typically, so it's a combination trade. So it's a couple different things kind of combined together using different expirations. So the first part of it would be an out of the money long put vertical, and I typically would go about 30 days to expiration on that piece. So what I would do is I would buy around the 30 delta and sell around the 20 delta. Okay. So, and so then you can model that piece of it.
Yep.
So typically what I'm looking for here, and the 30-20 delta, that's going to vary depending on duration, depending on the symbol you're trading, a lot, implied volatility environment, all that stuff. But really what I'm kind of looking at is I'd like to have about a 3-to-1 reward to risk. So
that makes sense to me. You're there.
Yeah. So that's right there. Okay, perfect. And then the other piece that I would add to this, if you go back to your option chain, is I would go back out to somewhere between like 75 to 100 DTE. So maybe say the
84,
maybe the 84. Yeah. And I would sell a far out of the money put. So like a 10 delta put.
Okay.
So add that to the model. I haven't set this up on your modeling tool, but yeah, so that's kind of the general shape of what it looks like. Now, a couple things. One, you have to be comfortable selling naked options here because you do have naked option exposure to the downside.
Yeah.
And so now, and so that's just kind of the general parameters of the setup. And then I would kind of tweak those strikes to get it to set up exactly how I want. And typically what I want to see is a pretty little valley there in the middle. And I like to see having a profit or at least no risk to the upside.
Okay.
And then what that gives you, it gives you a big buffer to the downside. So if, price does fall into your tent down there, as you get closer and closer to expiration, you're going to be able to book a pretty decent profit.
Yeah.
Now this trade I typically do on equities, whether stocks or indexes or whatever, because they typically have the skew of the option chain is typically favored to the put side. Yeah. Meaning the puts are more expensive than the calls, right?
Yeah.
However, in GLD or gold, or a lot of times in commodities, especially when they're pushing, extreme levels like we're seeing here.
Yep.
we know that the skew is on the call side, right?
Right.
So, and go to your option chain. I just want to show an example because I get a lot of questions about skew and what that really means. But yeah, go to the 31-day cycle right there. So go towards the at the money. So GLD is trading right around 412. So if you go up to 420 on the call side, so those calls are trading for about call it 865.
Yep.
And then go the same distance away on the put side. So you go to the 404 puts, and those are trading for 678. So, that just shows you an example of the calls are trading richer than the puts.
And that real quick, I think that's worth stopping just for a second. If you're not used to that, if you're used to just trading the indexes, that can be really, really hard to wrap your mind around sometimes. Everything in you doesn't believe that to be
right.
the case, and so, GME had this, GameStop had this, obviously, during the run-up. But, call skew, IV, how you look at that is you say, which direction causes IV to rise? And in gold, in a commodity, IV rises when you have a massive move up because it's considered a hedge. And so just to, for anybody who's maybe on my brain length a little slower, it's good to stop and think about that.
No, that's the way I think about it too, is like, where's the risk? Like if the risk is to the upside, the calls are going to be richer. If the risk is to the downside, and when I say risk, I mean, where's the potential elevator move, right?
Yeah, that's right.
You hear in the stock market, it's stair step up, elevator down. On commodities, it can be the opposite, right? It's stair step down and boom, shoot up if something wild happens. So it's just kind of the opposite. So, based on that, you could actually do a reverse hedgehog, which would be on the you're basically doing the exact same thing except on the call side. So if you go back to the 31-day options,
get rid of those.
Yeah, and I this looking at what you quickly modeled on the put side, it's definitely tradable. I mean, you could set it up so you have no risk to the upside and you have a nice buffer to the downside.
Yeah.
But let's set it up on the call side and see what it looks like there. So on the calls, go to about the 30 delta and buy that one. Go down to about the 20 delta or maybe a little further. Go to the 16, sell that one.
Yeah.
And then go out to that, whatever it was, 84-day, and then sell about a 10 delta call.
Yeah. Let's see here.
So now you have the same thing to the opposite side, and again, you can kind of tweak the strikes if you're going to actually trade it, and get to the downside, a big buffer to the upside where the profit is. And the key to this is the management. You're not going to hold it all the way to expiration of the front option. I'm typically getting out with anywhere from 7 to 10 days before expiration. Okay. And what that allows you to do is almost not completely avoid that little valley in the middle, but it would be a very minimal loss.
Yeah.
And then if it crashes to the downside, in this case, minimum loss, or you could set it up with a little profit. And then if it kind of creeps up into the tent, as you get closer and closer to that kind of 7 days to expiration, you can book a pretty significant profit.
I want to look at that, just collecting that credit for a second to see, it's interesting to the point because looking at the delta, for instance, as you go through this, time is, you're okay on that. You don't want it to go too far, too fast, but as time's going, you kind of need it to move with that little, I always call it the green ghost.
Yep.
But it's a timely thing. You don't want it to go too far.
That's right.
And so you're kind of just letting it ride as you go. I mean, because it's not like with such a small credit, you're not banking on like getting out based on theta, right?
Right. Exactly.
It is what it is. And so,
and because it has a couple different expirations, it does have that calendarized component to it, which, if you've traded calendars for any period of time, that all of a sudden you can have a situation where the implied volatility between the front options and the back options, work, in the right way, where the short options decay a lot quicker than the back, or the back expand quicker, and you can get a pretty decent quick pop in profit on these too sometimes, if you get lucky, basically.
Yeah, no, that makes complete sense. And you doing this versus like an iron duck, what are the benefits to this over doing something where you're like collecting a bigger credit? But
yeah, I don't know. I don't necessarily compare it to that. I think it's just a totally different type of trade.
yeah, makes sense.
I guess the question is, when would I do one or over the other? And I don't know. I think it's just kind of a preference.
It's kind of a feel thing
that you kind of come up with. Now, I mean, one thing is, remember, this has a naked option component.
Yeah.
If you're doing call side, you got that naked call to the upside. If you're doing the puts, you got that naked put to the downside.
Yeah.
And so if you're trading GLD, for example, and specifically if you're trading it in a standard margin account, it is going to use a decent amount of capital compared to the amount of profit potential.
Yeah.
So there's a couple ways around that. One, if you have a portfolio margin account, it becomes a very efficient trade from a capital usage standpoint.
Yeah.
The other option, if you don't have portfolio margin, and the way that I used to trade a lot of these is I would do it on the actual futures and use futures options.
Yeah.
So, you could model this out on GLD, and then you could actually take the concept and implement it on /GC.
Yep.
On the futures, on the gold futures, and have a pretty similar thing with a lot more capital efficiency.
Yeah, a lot more juice, closer to like index pricing.
Yep.
I did it. I was telling them yesterday. I did a double calendar Friday, and I opened up a 923, 1024, something like that, double calendar, and it was a 20 delta, I think, double calendar on each side, pretty neutral. And by Sunday night future open, I mean, I had breached that by 60 points. I mean, those are the moves that you're getting in gold right now.
Right.
And, a 9-day 20 delta is pretty far. So the fact that it just didn't care at all is pretty interesting. So that's a super interesting strategy, Steve. I mean, when you look at it and people say, I want the exposure, and, what are you playing? You're playing that it doesn't go past your strike by the certain time.
Right.
Is there a way, just to get fancy, to get crazy? Is there something that you could do that maybe if you really believed that it was going to pop to the upside, other than just buying, a call or something like that, because the IV exposure is so high in that?
Yeah, I would say if I was going to take a shot at a long position, I would probably just do kind of an out of the money long call spread, where you have a little bit of an asymmetrical risk to reward, kind of like just the first component of that call side hedgehog, and, choose your duration, buy maybe the 30 or 40 delta, and then do it, I don't know, 10 wide, 15 wide, 20 wide, whatever.
Yeah. You could go a little bit closer just to get, I mean,
and then, you're putting on the amount of risk that you're comfortable with, and, you're getting a bigger profit than you're risking if it does, in fact, continue to rocket higher like it has been.
Yeah. And another thing, a reason perhaps to consider GC is, I think GC has more expirations. I could be wrong, but I think gold is still, I don't know. Let me look at this real quick.
Yeah, you're correct.
Okay. Yeah. GC has more expiration. So you can play kind of like a 0-day or a 1-day. Now, I will warn you, just as someone who has lost plenty of money on gold in the past and look forward to losing more money in the future, gold moves overnight a lot. And so don't think that you're going to just open at market open and have a play in it. I also believe that it closes at a different time than 4. So you have to look at that. I don't remember off the top of my head. So that's why perhaps gold, GLD, if you're just getting started or you don't want a crazy amount of exposure,
right,
is a fine one to do, or anything like that. So, I mean, what comes up must come down. And so if you're bearish on gold, the hard thing is because of the skew. Let's say you just bought a put, right? And you think, well, I'm going to make a lot of money as this thing goes down. Well, the problem is, as it goes down, because it's call skew, IV is actually, it's like VIX in some ways. Like people think, well, I'm just going to fade this VIX move. Well, you're not going to get, it's going to be pennies on the dollar by the time it gets down there because of the IV crush.
Right.
And so I think it's an interesting thing to think through, Steve. I know people are always looking to kind of diversify, and what better way to diversify than something that moves 5% a day.
Yeah.
Do you ever do any day trades on gold or anything like that? Is that an ETF that you look at, or?
I really don't. When I was trading more futures, it was definitely one of my, main, directional futures on watch. But yeah, I just haven't done much with it at all recently.
It's an interesting concept of just when things start moving like that, it always just gets a little crazy to me, because you get the people who are kind of like crypto minded of like, hey, let's ride. Right. But they just don't know. They don't know enough about it. And that's the funny thing. I mean, they don't know enough about crypto either, but that hasn't stopped them. So any other ones you can think of as far as like ones you'd model if someone came to you and said, hey, gold's moving 5% a clip, what should we do?
Yeah, the Hedgehog was kind of the main one that I was thinking about. Yeah, I mean, obviously, just anytime when I sell premium, let me check out like the volatility of gold right now.
Yeah.
When I used to do a lot of premium selling, selling longer duration iron condors or even naked strangles, I definitely like to sell premium when the implied volatility pops, right? And then because it's mean reverting, you get that decay coming in quicker. But I don't like selling premium when implied volatility is at extreme highs, which I would consider. I mean, prices at an extreme, implied volatility I would consider kind of still at an extreme here, even though it has come down a little bit here in the last week or so. But I would, I personally, I wouldn't be selling kind of delta neutral, especially naked options here. But an iron condor could work, and you could even skew that a little bit in one direction. So if you had a little bit of a bullish bias, but you thought it may just kind of chop around here, you could kind of skew your iron condor to the upside. Or if you had the opposite, you had the bias a little bit to the downside, you could skew it to the downside. So that would, that would be something that would be another option.
Just to show them that real quick, let me just go a little bit farther out here. I have no idea what this is going to look like, but that's a more bearish, obviously, version of it. But the idea is similar. And you could say, let's say this is going to be 440, 450. You could do something like that. The thing about condors that's always interesting is you can set them up in different ways with different credits, and you can say, hey, where do I want my risk to be concentrated?
That's exactly right. That is the question you should be asking yourself. Where do I want the risk, and where am I comfortable with more risk, and where am I comfortable with less risk?
Yeah. And you have to make that decision, yourself, someone, and as someone who has traded a lot and people follow your trades a lot, I mean, I imagine the more neutral, the better for you when telling people, just because it's like, I want to just get in and get out. I don't have a macro view on this thing. I'm not looking for it to go up or down,
Yeah. And I mean, I definitely take assumptions based on, my opinion or my analysis or whatever you want to call it. But the main thing is, I mean, the thought process for me is I don't necessarily think I'm going to be right on this trade. What I'm doing is I think I'm willing to risk this amount of capital based on my assumption, and let's play out the probabilities.
Yep, that's your probability guy, and I like it because of that. I'm trying to look at real quick. Let's it's not going to be exactly what I want. But just, again, these type of structures where you say, I'm willing to take a little bit. And with this type of stuff, Steve, if someone wanted to get exposure to it and do neutral stuff, do you have any thoughts on like X days, DTEs, and then what profit target? Should you get out early for a profit target? Should you let it ride?
Yeah, I mean, there's obviously, so there's the tasty way, which is your kind of 30 to 60 days to expiration.
Yeah.
Close it out at, I think, 50 around 50% of credit, and then roll when you get down to like 21 days, I think is their kind of their core criteria. And they've done a lot of studies around that, and that's what they like to do. I would just say, again, not to beat around the bush and not give a direct answer to you, Troy, but I think it really comes down to what type of trader you are. Are you the type of person who has a 9-to-5 job and you are wanting to put something on that you can maybe check once or twice a day? Or are you actively focused and at your computer and you can kind of watch it like a hawk? Because those two factors really matter, right? If you're okay, focusing and being there and managing it on an active basis, you could go shorter term. You've got the risk of the moves happening quicker and your P&L swings happening quicker, but you're there to actively manage it. If you're not, then you've got to go longer duration. You might want to go wider so that every swing doesn't have much as big of an impact on your P&L, and you can kind of stomach that the swings in the underlying that you're trading. So it really just comes down to everybody's personal situation and what they can stomach.
Makes total sense. And then 2 more questions, and then I'll let you go today because I know you're trading and I've got to eat more chicken. I'm training, Steve. I'm trying to get people keep telling me I have the potential, but I'm getting too old. So we'll see what happens.
Is that your New Year's resolution? Are you the guy in the gym on January 1st?
I don't know if you saw, we hired a friend of ours named Brian Chia. He's the head of product, and he, strangely enough, introduced me to you, which is a wild world. And so, but he is, I've said this before, he's the strongest human being I've ever met in my life. And he taught Rusty and I how to deadlift and do some workouts. And so it's perfect timing. He's back. I'm back. We're trying to make it work. But anyway, two quick things. Someone wants to know, could you show us an iron duck in gold just to see what it would look like?
Sure.
Okay. So what do I need to do here?
Let's go to SPX. That's just kind of my favorite symbol to trade it on.
Yeah.
I always like to go to around 21 days to expiration. That was always kind of my sweet spot for duration.
Okay.
You can do it shorter, you can do it longer, but 21 days just for consistency, I would always kind of gravitate to that duration. So on the call side, go to about the 65 delta. So you're going a little bit in the money, sell that one, and then buy the one 5 wide. So the 68.80. Then go on the put side and go to about the 16 delta, sell the 67.25s, and then buy the one about 20 wide. Or it looks like you got to go 25, so 6700s.
Yeah. Okay.
See what that looks like.
Yep.
Yeah, it's pretty good. So,
yep.
So the structure is you've got no risk to the upside, and you'll usually make about, I don't know, 5, 6, 7% on the upside if it just rips higher. So you have no risk to the upside. You've got that, what I call the duck head, which is your max profit. So the beak is your minimum profit. The duck head is your max profit. And then to manage risk, I don't want to let this thing go to max loss if price is really dropping, but I would close it out if it gets down to about the downside break even of that structure, which would be about, what is the price there? 67.
At expiration, or just kind of at the point of
just hover near the downside break even at expiration.
Yeah,
I was just trying to figure out what
67.19.
Yeah, right there. Yeah, so if price started getting close to that level, that's where I would just cut out of it.
Yep, makes total sense.
You can do the same thing. When I first started trading it, that's how I set it up. Go back to the option chain. You can kind of do the same thing, but just do all out of the money puts instead of using that in the money call side. You can just switch those over to the put side and do the same strikes. So go to that.
I don't remember which one.
Whatever they were, 67.70. Oh,
my way out.
Go closer to the money. There. Okay. Yeah. So go to the, I think so go to the inverse of the 65 delta on the call side. So go to the 68 75s, sell that one and buy the 68.80.
Did I do that right? Don't look, I did that right.
Yeah, buy the 68.80.
Oh, 68.80, sorry.
Yeah.
And then get rid of which one of these? Don't get rid of.
Get rid of the 70s.
Right there?
Yeah. Yep.
Yeah. Yeah. And so people think, well, how did that work? If you're new to options, that's called put call parity. Especially with European style options. A put is a call and a call is a put. You can look that up. It's really interesting. Helps a lot to understand it. So one more question, Steve, I'm gonna let you go. The Dog-a-lot, that's a great name, Dog-a-lot 1. Mahomes trade. So I presume he's talking about Mahomes. And then 2, do you just do Mahomes and SPX because it's European, or would you do it in anything else?
I wouldn't do it in anything else.
There we go.
Yeah, I mean, you could do it in RUT or NDX, but those are just so much less liquid. And
well, yeah, you're liquid
day, and it's
NDX and Mahomes would be a nightmare.
Unless you're just putting it on and letting it go to expiration, but even getting filled on the entry would be problematic.
Yeah. And listen, if for those who are like Iron Ducks, Hedgehogs, Mahomes, what the heck are we talking about? For those who don't know, Steve runs community navigation trading. Check him out. NavigationTrading.com, I believe, Steve. Is that right? Yep. All right. And you'll find him there. He's in Discord all day doing trades. He and a few other people taught me options. And so it's an honor to have you every week. And I look forward to it next week, Steve.
Thanks. Yeah, it's a lot of fun. We stream for the first hour and the last hour every day. It's a lot of fun. Sometimes there's nothing going on and we just kind of BS with each other and make fun of each other. And other times there's some good stuff going on. So
those are my favorite times.
No matter what.
My favorite times to jump on is when there's nothing happening and I just troll. So anyway, well, listen, Steve, have a good rest of your trading day, and we will talk to you guys next Tuesday. I'll be back on 3:30 small account challenge. I'll see you guys then. Have a good one.
Thanks, Troy. See you, everybody.
Thank you.